Ever feel like your money just doesn't stretch as far as it used to? That $100 in your wallet today buys way less than it did last year, or even a few months ago. It's not your imagination. That feeling of your money slowly vanishing is a real economic force called inflation, and it's silently eating away at your savings and your future. But what if I told you that understanding this one concept is the first, most crucial step to not just surviving, but actually thriving financially? Stick with me, because today we're demystifying inflation. We'll break down what it is, why it happens, and most importantly, what you can do right now to protect your hard-earned money. This is the start of your journey with Wealthnetic, where we make complex finance simple so you can build real wealth. So, what is inflation in the simplest terms? It's the rate at which the general level of prices for goods and services is rising, and as a result, the purchasing power of your money is falling. Think of it like a pizza. A few years ago, $20 might have bought you a large, fully loaded pizza. Today, that same $20 might only get you a medium with 1 or 2 toppings. The $20 bill is the same, but the amount of pizza it can buy has shrunk. Your money is worth less. It's a slow, often invisible, tax on your savings. Now, this process is usually gradual, a few % a year. But history has shown us some terrifying examples of what happens when inflation spirals out of control. This is called hyperinflation. In the Weimar Republic in Germany after World War I, people were carting around wheelbarrows full of cash just to buy a loaf of bread. Prices were doubling every few days. More recently, in Zimbabwe, the government printed $100 trillion bills that were barely enough to buy groceries. These extreme cases show us why even small, creeping inflation is a beast we need to understand and respect. It's a silent wealth destroyer if left unchecked. So, the big question is, why does this happen? Where does inflation come from? There are 3 main culprits. First, there's demand pull inflation. This is the classic, too much money chasing too few goods scenario. Imagine everyone suddenly gets a big stimulus check, just like we saw after 2020. People have more money to spend, so they rush out to buy cars, renovate their homes, and go on vacation. But the number of cars, contractors, and flights hasn't increased. With more buyers than sellers, businesses can and to raise their prices. The demand is pulling the prices up. The second type is cost push inflation. This happens when it becomes more expensive for businesses to produce things. Think about disruptions in the supply chain. If a major port shuts down, it costs more to ship goods. If the price of oil skyrockets, it costs more to transport everything, from food to electronics. If there's a labor shortage, and companies have to pay higher wages to attract workers, they often pass those extra costs on to you, the consumer, in the form of higher prices. The cost of production is pushing the prices up. And the third factor, which is fascinating, is expectations. If people and businesses expect prices to rise in the future, they change their behavior today in a way that makes it a self-fulfilling prophecy. If you think a new phone is going to be $100 more expensive next month, you're more likely to buy it now. If workers expect inflation to be 5%, they'll demand a 5% raise just to keep up. Businesses, anticipating these higher wage costs and seeing strong demand, will raise their prices in advance. Inflation becomes a psychological game. So who's supposed to manage all of this? This is where central banks, like the Federal Reserve in the US, come in. Their main tool to fight inflation is adjusting interest rates. When inflation is high, they raise interest rates. This makes borrowing money more expensive for both people and businesses. Mortgages, car loans, and business loans all get pricier. The goal is to cool down spending, reduce the demand, and bring prices back under control. It's a delicate balancing act, because if they raise rates too aggressively, they can tip the economy into a recession. Okay, this all might sound a bit gloomy, but here's the good news. You are not powerless. This is where we move from theory to strategy. How do you protect your wealth and even grow it during inflationary times? First and foremost, holding large amounts of cash is a losing game. That money in your savings account is like an ice cube on a hot day it's melting. The interest it earns is almost always lower than the rate of inflation. So, Your goal is to move your money from things that lose value to things that can outpace inflation. This means investing. One of the most proven long-term hedges against inflation is the stock market. When you buy stocks, you're buying a piece of a real business. As prices rise, good companies can often pass those costs to consumers, and their revenues and profits grow. Over time, the stock market has historically delivered returns that have significantly beaten inflation. Another classic inflation hedge is real estate. When inflation hits, the cost to build new homes goes up, which tends to push up the value of existing homes. If you're a landlord, you can also typically raise rents to keep pace with the rising cost of living. Your property value and your rental income can both grow with inflation. You can also look at commodities. These are raw materials like gold, oil, and agricultural products. Their prices are literally part of the inflation calculation. So when inflation is rising, the value of commodities often rises too. Gold, in particular, has been seen for centuries as a store of value when currencies are weakening. There are also specific financial products like TIPS, or Treasury inflation-protected securities. These are government bonds where the principal value increases with inflation, guaranteeing that your investment keeps its purchasing power. Now let's talk about debt. During inflation, debt can be a double-edged sword. Bad debt, like high-interest credit card debt, is always bad. But good debt, like a low, fixed-rate mortgage, can actually become a secret weapon. Let's say you have a 3% fixed-rate mortgage. If inflation is running at 5%, you are effectively paying back your loan with money that is worth less and less each year. The real cost of your debt is shrinking over time. But perhaps the single most powerful asset you have is you. Your skills. Your ability to earn more money. Inflation erodes the value of a dollar, but it can't erode your expertise. By investing in yourself, learning new skills, and finding ways to increase your income, you can ensure your earnings grow faster than your expenses. This is the ultimate way to stay ahead. Whether it's a side hustle, a promotion, or a new career path, boosting your earning power is your best defense. And finally, the golden rule of investing always applies. Diversification. Don't put all your eggs in one basket. A healthy portfolio might have a mix of stocks, real estate, maybe some bonds, and even a little gold. By spreading your investments across different asset classes, you reduce your risk and increase your chances of capturing growth wherever it may be. So, let's recap. Inflation is a silent thief, a decline in your money's purchasing power. It's driven by high demand, rising costs, and our own expectations, and it's managed, or attempted to be managed, by central banks. But you're not helpless. The key is to stop being a saver in the traditional sense and start being an investor. Move your money out of cash and into assets that can grow, like stocks and real estate. Use fixed-rate debt. Kombinasawan. Most importantly, invest in your own skills to increase your income. This is the mindset of Wealthnetic. It's about being proactive, not reactive. It's about continuous learning and taking control of your financial destiny. Understanding inflation is just the first step on this journey. I hope this has helped clear things up. If you found this valuable, please hit that like button and subscribe to the channel. We're just getting started. In our next video, we're going to dive deeper into exactly how to start investing in the stock market step by step. Drop a comment below and let me know the one thing you learned today that surprised you. Thanks for watching, and I'll see you in the next one.